The market is currently closed as it is the weekend. As of the closing bell on Friday, October 17th, 2025, Denison Mines Corp., ticker DNN, ended the session at $2.92 per share. That was a sharp drop, a significant move down of 5.50% or 17 cents on the day. And right there is the immediate disconnect, the tension that defines this stock. Many investors who just glance at their Fidelity account or Robinhood app on the weekend might see the previous close, which was $3.09, and assume things are stable, just coasting above that critical $3 mark. The reality from Friday's actual trading session tells a much more violent story. It was a heavy volume flush with nearly 88 million shares changing hands. The stock failed to hold its ground, gapping down at the open to $2.91, and after a brief attempt to rally that stalled at $3.08, it sold off for the rest of the day, settling right near its intraday low of $2.85. This wasn't a drift, it was a rejection. The common belief surrounding Denison, and frankly the entire uranium sector for the last 2 years, has been one of pure, unadulterated momentum. It's been a buy everything story, a simple narrative. Nuclear energy is the only viable solution for baseload zero-carbon power. The global supply deficit of uranium is real and structural. Therefore, developers like Denison, sitting on some of the highest-grade undeveloped assets in the world in Canada's Athabasca Basin, are the future. This stock, and others like it, have been darlings for the self-investing community. It's been a go-to name for anyone using SoFi Invest or opening an individual brokerage account to get direct exposure to the new energy trade. For a while, it's been seen as a can't-lose proposition, a junior miner that has been trading with the velocity of Tesla stock, not a typical boring commodity play. The expectation is that the line only goes up. But Friday's 5.5% drop on that massive 88 million share volume tells a very different story. It suggests that this broad, optimistic expectation is smashing headfirst into the reality of a show-me market. This isn't just a small, healthy pullback, it's a significant technical break. The question is no longer if the long-term bull case is good, but when it actually gets priced in, and more importantly, how much dilution, patience, and execution risk investors are willing to tolerate to get to that future. This pullback from the 52-week high of $3.42, which was set just recently, is now seriously testing the conviction of the online investing crowd. Is this just a healthy consolidation before the next leg up, or is it the first major crack in the armor? Let's really look at this recent price action, because it's where the story is. The run from the 52-week low of 108 to that $3.42 high was staggering. That is a more than 200% gain. Trees do not grow to the sky, not even for uranium. What we almost certainly saw on Friday was a potent combination of sell the news psychology, even if the news is just the general sector hype, and significant heavyweight profit-taking from institutions. When you see 88 million shares move, that is not just retail traders on their Robinhood stock trading app buying Robinhood fractional shares. That is institutional weight. That is a fund that bought in at $1.50, deciding to take some risk off the table. The stock sliced right through the $3 psychological support level as if it wasn't even there. This is a critical technical event. Now, the next key area everyone is watching is that intraday low from Friday, $2.85. If that level breaks when the market opens, technical analysts will be looking straight at the 50-day moving average, which, based on the recent charts, is likely sitting somewhere in the 279 to 281 range. A close below that could trigger a new wave of automated selling from algorithm-driven funds, the kind of strategies that might be part of a larger intelligent portfolio or a Schwab intelligent portfolios that is programmed to cut losses at key technical breaks. The options market is practically screaming a warning. Recent data shows an implied volatility percentile in the 99th percentile. To be clear, that means options on DNN are incredibly expensive right now. The market is pricing in the expectation of massive future swings in either direction. This is not the sign of a stable, mature stock. It's a coiled spring. What's interesting is the put-call volume ratio is very low, around 0.13. On the surface, that looks wildly bullish, many more calls being bought than puts. But you have to be careful. In a high volatility environment, this could also mean sophisticated traders on the Interactive Brokers platform are selling those expensive calls, betting that the stock won't breach new highs in the near term. Given the speculative fever, it's likely a mix of both, but it's pure speculation at this point, closer to trading Robinhood crypto than a stable investment. Now, let's talk about that smart money. Who is actually involved here? Fintel data from this month, October 2025, shows 264 institutional owners have filed with the SEC holding over 594 million shares. That is a huge increase of 11.35% in shares held just in the most recent quarter. So, while Friday was a brutal sell-off, the bigger, slower-moving picture is that major funds have been buying this stock. We see the big names you'd expect: Van Eck Associates Corp., Alps Advisors Inc. These aren't small shops, they are the operators of the massive uranium ETFs like URA and NLR. This creates a powerful feedback loop. As more online investment flows into these thematic ETFs from people using Fidelity ETFs or similar products, those ETFs are forced to buy more shares of DNN, which is a top holding. This pushes the price up, which attracts more inflows. But what happens when those flows reverse or even just pause? Friday might have been a small taste. This is why investment in thematic ETFs can be a double-edged sword for the underlying stocks. So what is the expectation for Denison Mines built on? Why all this institutional buying and retail fervor for a company that isn't profitable? This isn't Apple stock, which sells a billion high-margin devices. This is a mineral exploration and development company. They don't have a commercial product right now. They are not profitable. Their earnings per share over the last 12 months is -7 cents. They are, at their very core, a high-potential, extremely high-risk bet on the future price of uranium and their ability to execute. Their entire story, the whole bull case, boils down to one piece of geography: the Athabasca Basin in Saskatchewan, Canada, and specifically their flagship Wheeler River project. This is their crown jewel, an asset Denison has a 90% and 95% interest in, depending on the deposit. Wheeler River isn't just any uranium project, it's host to two of the highest-grade undeveloped uranium deposits in the world in Canada's Athabasca Basin. The real excitement, the narrative that has traders on SoFi, SoFi Investing, and SoFi Active Investing platforms buzzing, is the Phoenix deposit. This is the asset that separates Denison from almost every other junior miner. The plan here is to use a method called In-Situ Recovery, or ISR. This isn't a giant, environmentally complex, and massively expensive open-pit mine. It's a method of dissolving the uranium ore body underground and then pumping the solution to the surface for processing. It's supposed to be dramatically cheaper, faster, and have a much smaller environmental footprint. The 2023 feasibility study for Phoenix showed numbers that are simply staggering. It projected an after-tax net present value of $1.56 billion and an internal rate of return of 90%. You just don't see numbers like that. This is what a Fidelity wealth management advisor would point to as the blue sky long-term potential. Then you have the Gryphon deposit, a more conventional and more expensive underground mine, but still incredibly high grade. The company even announced new high-grade discoveries at Gryphon back in July, expanding the mineralized zone, which adds another layer of potential value. And Denison's management made another very smart move. They aren't just a developer burning cash. Years ago, they began buying and holding physical uranium. As of their first quarter 2025 report, they held 2.2 million pounds of U3O8. As the spot price of uranium has climbed from $50 to $60 to $70 and beyond, the value of this stockpile on their balance sheet has ballooned. This gives them incredible financial flexibility. It's a hedge, it's a source of non-dilutive capital, and it gives their shareholders direct exposure to the rising commodity price while they wait for the mine to be built. It's a key differentiator from other developers who are just burning cash every quarter, and it's a reason many Fidelity brokerage accounts hold this name for their clients. So, we have this incredible expectation, a 90% IRR